about passive is obviously we've done a lot of innovation in the passive investment. So almost out of the 8 funds that we've launched so far, 6 of them are completely brand new. They are a new category fund and the only one of its kind in India. So we're also now going into the solution space where we're offering investors solutions where they can do all of their asset allocation needs in one fund. But before that, let me talk about why these funds are very significant. The ones we've launched, so I also wrote an article about 6 months ago talking about minimalism investing, and in today's time when everybody there's an NFO being launched every second day, and there's so many options, there's so many mutual funds, there's so many types of instruments that you can buy. My whole article talked about the power of one. You really don't need more than one mutual fund in the portfolio. As an investor, to take all the noise in the market, then one fund is actually sufficient for your investing needs. I think that article did pretty well, and essentially that was an equity fund that I talked about. But essentially, today we all know that I think asset allocation as a concept is extremely important. So today we're launching funds that do asset allocation. This is very different from a multi-asset fund where you're essentially buying 4 different asset classes. Here, what we're trying to provide an investor is actually a portfolio where we do the asset allocation and we give options to the investor. We have a conservative, aggressive, and moderate based on their risk profile. And we also do the rebalancing and we make the allocation completely static. So the investor who buys an aggressive portfolio will buy the same portfolio or buy the same allocation for life. So I think, I certainly believe that if an investor is willing to, take out of the noise and is okay to, just invest in one single fund, we do feel that, this fund is sufficient in all order. So let me just quickly go through the presentation. I don't want to bore everyone with the specifics. This is a very, I would say, nerdy presentation, but sorry. But I'll just go through some of the important slides. So most importantly, what is asset allocation? It's a very important concept. It's probably the most important concept in investing. Every investor should follow asset allocation as a strategy for investing. And essentially what asset allocation is not really to do with how much you spend or how you spend. It's about how you allocate your money across different asset classes. So today, I think there's 2 things. One is an investor needs to decide, what to buy. But that actually is not more important. All of us spend all of our time deciding this fund to buy, that fund to buy, this fund to sell, this fund to sell. But essentially that sort of choice is not as important as asset allocation. So your decision of how much of your wealth be distributed into equity versus debt versus say gold versus international equity is the most important decision. And I'll show you why in another slide. But essentially what we've seen is that there's 2 types of asset allocation. One is a strategic one, where you will ensure that you will hold the same allocation for your entire life over a very long time period. The other one is tactical asset allocation, where depending on market conditions, you will determine when to do equity or when to be aggressive, when to be conservative. So essentially, there are 2 different types. What studies have shown is that strategic ends up becoming a lot more effective over long-term periods, because what people have realized that it's almost impossible to consistently time the market and intervals. So these 2 funds that we're launching are both strategic asset allocation funds, and I do believe that these are the only strategic asset allocation funds in India today. Very important stat that we as investors love to chase past performance. We love products that have high past performance. We love products which are always delivering good returns in the past, and we can to buy those funds in our portfolio. But what we've seen is that if you keep buying last year's best performing asset class, that is not a good strategy. Whereas you're only making, say, a return of 8% if you do it for 13 years consistently. In fact, if you buy last year's worst performing asset class, your returns are a lot higher. But whereas the best strategy for an investor is to just do equally weighted, which means if you're investing 30% in equity, then make sure that 30% remains the same for the life of the fund. Don't mess with the 30%. Don't buy the highest performing or the lowest performing. Stick with that allocation of period of time, which is strategic. And that's why we think that this is probably one of the best strategies for investors in terms of asset allocation. So how important is asset allocation? So this is a pie chart that shows how long-term returns are delivered. And we all spend so much time in security selection and market timing. We know, at least studies have shown that market timing does not matter, and also market timing is very difficult to do. It's very hard for you to, really predict which asset class or which fund or which, security will do well, stock will do well in the future. So we do spend a lot of time here, but we also spend a lot of time in trying to figure out what to buy. But essentially what we've seen, and this is on study, that 91% of your returns come from asset allocation. So essentially, even though we spend most of our time here, the most important determinant is asset allocation. So the fund that we've launched is actually focused on this 91%. It doesn't really matter what large cap fund I buy, or what small cap fund I buy, or what debt fund I buy, as long as I know how much I'm investing in each asset class. This is just a primer about us at Motilal Oswal AMC. We've been pretty active in the index funds business, and we've launched funds across all categories this year. And we are market leaders in the international fund space. So if anyone has a question, it's more than happy to answer. But if anyone looking at any index funds, you can, we will have the fund that matches that category. So essentially, we're launching two funds, an aggressive fund and a conservative fund. We also have a secret moderate fund, and that is basically you just combining 50-50. So you can do 50% aggressive, 50% conservative, and you will get like a portfolio which is similar to a 60-40 portfolio. But essentially, aggressive portfolio will have a much higher equity component than a debt, and the conservative will be opposite, where the debt will be a lot higher than aggressive portfolio. What's extremely important out here is that the allocations that we make in these funds are going to be exactly the same. So if the aggressive allocation has, say, a 60%, or I think it's got a 70 or 75% investment in equity, we will keep it there for the life of the fund. So if you buy the fund today versus 50 years from now, the allocation is going to be exactly the same. And so is for the conservative fund. And we also rebalance the fund. So how does that work? Today, if you buy, say, a 70-30 or an 80-20 portfolio, over time, what you'll see is that the equity portion grows at a much faster rate than the debt portion. So and we have to continuously bring it back to the target asset allocation. So exactly the same in these two funds, we do rebalancing, where if the equity is supposed to be at 70, but then goes to 75, we bring it back to 70%. So that's how we do it. We do it every quarterly. And the good part about this fund is that, unlike an investor can easily do this at his or her end, but they will be having a capital gains because you're selling winners, you're buying losers. Whereas in this fund, the rebalancing is typically tax-free because mutual funds don't pay tax. What funds are we using? As I said, security selection matters less. What really matters is asset allocation. So the weights that I will come to in the slides ahead are a lot more important than what we choose. But essentially, an equity fund, you're getting 4 asset classes. You're getting equity, you're getting debt, you're getting international equity, and you're getting gold in this single fund. In your domestic equity, we're using Nifty 500, which is an all-market index. It covers 95% of the entire Indian market cap, and it has exposure to large cap, mid cap, and small cap. So great fund over a very diversified fund over a long time. On the debt side, we're using a 5-year GSEC, which is a GSEC fund. So investors don't have to worry about credit risk, and the performance of this is being pretty good. International equity, S&P 500, I'm sure a lot of you would have heard about this fund. It's a very popular fund and very successful as well, also one of the world's largest funds out there. So S&P 500, it's top 500 securities in the US. It's a large cap US fund, and you have some of the really big names in this fund. And lastly is gold. Gold is a very interesting asset class because the performance is not consistent, but gold's performance tends to be really good when equity markets are bad. So if you've seen over the last 20, 30 years, whenever equity markets do badly, gold tends to do really well. So I think that is why gold is a great asset class to have to hedge some of the downside that we can get from equity because of corrections that you see. So I think I'll come to the weights of the fund in a while, but essentially what you're seeing is that, I think this is the weights that we've used for this fund. So essentially the aggressive fund will have the equity, which is around 70%. So, and debt will 20% and gold 10%. Whereas conservative fund will have around 30% in equity and 50% in debt, and the rest will be in gold and S&P 500. So essentially, this is the indicative weights that we have for both of these funds. These weights are going to stay exactly the same over the life of the fund. So you will ensure that you will always be investing in a fund which has similar weights. We also have a combined fund, 50-50, which will have the combined weights. So in that case, it's a moderate portfolio, which approximately 60 and 40. 60 will be equity and 40 will be combination of debt and gold. So what are the attributes of the fund? Very quickly, one is obviously it's very diversified. So you're essentially getting 4 asset classes that are completely uncorrelated. So you don't have to worry about, obviously your downside is protected. And especially in today's market when equities is at all-time high, international equities all-time high, gold was the top performing asset class, and even debt interest rates are very low. It's very difficult for you to decide what to invest in. This is where this fund comes in, where you don't have to worry about equity doing badly or gold doing badly or international doing badly. You're essentially deploying your money across 4 different asset classes, and if one does badly, you have the other 3 to protect it. So I think very diversified and will give you downside protection, which I think a lot of people are looking for in this sort of a market. Again, risk profile is very important. We are giving options, three options to investors. We're also reducing risk in the portfolio by having a multi-asset strategy. The rebalancing is tax-free, as I said, and obviously the most important bit is cost. The cost of these funds are approximately, the underlying funds are approximately 0.3 to 0.4%. So if you look at the underlying cost of the funds, so one of the lowest cost funds you can get out there, and you're getting and you're essentially getting an entire portfolio for a very low cost, and we're also rebalancing for you. So I think very important. I'm just going to show you the importance of diversification or low correlation. So as you can see, this chart, shows the different indexes. So you have a large cap index, you have mid cap index, you have a small cap index. Today, a lot of people feel that if you buy a large cap, mid cap, and small cap fund, you're diversified. But as you can see, it's not really the same. So equity tends to move together. So you're not really getting any diversifying if you're investing across different mutual funds, but in equity. But look at the chart for a multi-asset fund. It's superb. It's really diversified. And when one does badly, you have others to cover up, and vice versa. If, for example, tomorrow gold does badly, your S&P 500 will do well. So essentially, you're getting 4 different asset classes that move completely different directions, which is extremely important when you're buying on a risk perspective. Also, rebalancing, what we've seen is that rebalancing at the fund level gives you 1.5% more returns. So this is an important concept for investors who rebalance frequently. Let's look at performance, and then we come back to why multi-asset is really good. As you can see, performance is really good. Pretty much in line with what we'd expected. Aggressive will have a much larger performance, so close to 12 to 15% is what you can expect. Whereas conservative is around 11 to 12%. I think what is really remarkable about the performance is how consistent it is. As you can see, if you hold this fund for 2 years or 3 years or 5 years or 10 years, it's so consistent. Look at Nifty. If you hold it for 3 years, the performance is very poor. But if you hold it for 19 years, 20 years, the performance is really good. So it really determines. And same with S&P 500. Last 10 years of performance is 20%. But last 20 years of performance is only 11%. So I think if you look at individual asset classes, the performances are pretty varied. Whereas if you look at the consistency of this, it's pretty high. The second is that also the volatility is a lot lower. So we're looking at volatility for aggressive fund going down by 30 to 40%. And also your returns are pretty good over the long term. So I think the consistency of performance, the low risk, as well as the lack of poor performance is what really makes these funds very popular. And this is SIP performance, super good, to be honest, very consistent. This again is, I would say, a little bit complicated slide, but I'll make it slightly easier. So we've done 3-year rolling returns. So if you hold this fund for a minimum of 3 years, at any point in time, the last 20 years, you would see that your returns of negative returns is close to 0. Whereas Nifty 500 will give you there are chances of you making negative returns if you hold it for 3 years. But if you look at these two funds, there's close to almost no probability of you making less than 4%. Obviously, there's an 80% chance that you'll make more than 10 to 12%. But what is really important is that you're essentially getting a fund which also does not have bad performance in its track record, which I think is extremely important. And if you hold it for 5 years, then there's close to very little, I would say, reasons to you getting less than 8%. So you're getting a fund which is consistent, but does not have bad performance and has a much lower risk. So I think it's also downside protection. So you're essentially getting a fund which is, when markets are down, the aggressive fund is only down 50% and the conservative only down, say, 20, 25%. So you're essentially also getting downside protection in case markets don't do well, especially equity markets. You're also getting a fund that does really well across business cycles, in the sense that even if you buy this fund at extreme high valuations, the performance is pretty much the same. So we've simulated this fund across cycles where performance is extremely high, where markets are extremely high, and what we've seen is the performance of the funds is pretty much the same. And this is SIP. What's really surprising that even if you do a lump sum, the returns are pretty good. So essentially, even if so there's no market timing risk. These are all weather portfolios. So a lot of investors now are wondering whether they should invest in the markets. It's so risky. Markets are so high. But this fund really, is an all-weather fund where you don't really have to worry about, mistiming the market, because the performance, regardless of when you invest, is really good. These are some of the, other funds in the market. These are obviously a lot cheaper because they're all passive funds, but also performance is a lot superior for anyone who's looking at other funds. These are all, I would say, more of funds. The whole idea is to, make sure the returns are a lot. But with these two funds, the idea is to just give you an asset allocation. This also shows why, strategic asset allocation is slightly superior than having a tactical asset allocation, which most of these funds follow. A lot of customers also compare a conservative fund to a debt fund. This may not be a very good comparison, but if people are looking for an aggressive debt fund, they can look at a conservative fund. And as you can see, performance is pretty good. So that's pretty much, I think, our presentation for today. I just want to quickly summarize and then we can open it up for questions. So essentially what you're getting is a fund that is diversified across different asset classes. So you're essentially getting a fund which has downside protection, a fund where returns are consistent, a fund where volatility is a lot lower, and a fund where the poor performance in the last 20 years has been close to zero. So essentially you're getting a lot of benefits if you hold this fund for 3 years and above. You're also getting funds with different risk profiles. So if you are aggressive, you can get the aggressive. If you are conservative, you can go for the conservative. And you can also buy the moderate if you combine the two funds. So different options. You're getting low cost, which I think is extremely important, because today, if you invest for say 20, 25 years, then cost becomes an extremely important component. So you're essentially getting something low cost. And lastly, you're getting something which rebalances on your own. So you as an investor does not have to worry about rebalancing. The fund does it for you or on behalf of you. So with that, would like to end here and we can open up for questions now. Thank you.
Prateek, thanks. That was really helpful. So maybe I can start taking a few questions, which we received from the viewers, and we can, go further, So, I mean, just a reminder that we are taking questions on our Facebook comment section as well. So if there's anybody who has any questions, they can actually shoot it and we'll, just try to address it real time. So why, just about, just broad question, which we've received is, I mean, and you probably addressed this as well. The expense ratio of this fund is 30-40 basis point, right? So that's quite phenomenal, Prateek, given, that there will be some churn as well. And, there will be some sort of rebalancing happening as well on a quarterly basis and so on. And do you intend to keep it that way? Or, is it something that is more like an introductory offer and might or might not change in future?
No. I mean, there's a high chance it might go down. It might go down from that because competition in the passive fund space is increasing. Yeah. So there's a very, very high probability of it going down from here in the next couple of years. But I honestly don't see a point of any reason for it to go up from here.
Great. And if Motilal Oswal Mutual Fund is introducing more international funds, will that also come into this fund of fund sort of scheme offerings, or is that not a possibility? The future launch.
No, so these, yeah. So it's a good question. We will be, but those will not be eligible for inclusion in this fund because these funds are static allocation funds. So essentially, I honestly don't see it happening because if you look at the S&P 500, the fund that we've chosen here, it's not really a US fund. Yes, it's dominated in the US. The companies are American companies, but if you see the revenue models, they come from all over the world. In fact, there's a statistic that says that 40% of the revenue of the S&P 500 companies come from their operations outside of US. If you look at other companies, Apple, Google, Netflix, Spotify, a lot of their operations are in India. So a lot of the India revenue, I think is reflected in their US stocks. So I think you're essentially buying a set of companies which are truly globally diversified, which is why I in fact call it a very simple diversified fund. So I don't think we'll see the need of buying another fund for the international component.
Great, Prateek. Thanks. So another question that we have is why not sectoral ETFs and index funds? in this fund as well. And let me just elaborate, the query which probably I had, is that when you were thinking about launching new funds, why did you go about, more of a asset allocation as a strategy? Why not go for more exotic sectoral ETFs and everything? Because one of the things that we were actually checking in the US markets, you do have something like very exotic products like marijuana ETFs, fintech, millennial focused ETFs, and all those products as well. So do you think the time is not right for India to get into that, or if it's a question of either or, which one do you first do? Then probably an asset allocation first, makes sense, and then obviously you can move further on in the journey.
Yeah, so the what we're trying to do is give investor a portfolio and give the investor an all-weather portfolio, something that he or she can invest at all times, whenever the next 10, 15, 20, 30, 40, 50 years. This portfolio will do well regardless of where the markets are, regardless of how old you are for 40 years. So it's actually a portfolio which will, essentially age well with time, and you can confidently put your money in this fund for 40, 50 years without even, I think, because you're essentially buying broad market funds in the US, broad market funds in India, the gold as an asset class, and a very simple GSEC fund. So essentially, it will stand the test of time. So we've optimized it for simplicity and longevity. The problem with sectoral ETFs is that I'll be honest, but most people lose money on sector funds. Because sector is a very dangerous category for most investors. If sector, in fact, is not a mutual fund, it's in between stocks and mutual funds. So I think the whole point about sector funds is for a stock investor who does not really want to sort of take a decision of whether to buy HDFC Bank or Axis Bank, and essentially go over the bank index. They essentially take out the individual risk out of the decision of making investing. But I would not really recommend investors buying sector funds for very long term, because essentially you really need an element of market timing for you to really make a lot of money in sector times. So what normally happens is that people end up buying marijuana ETFs, or they end up buying, I would say, electric car ETFs, or some of these themes when everyone is talking about it. And guess what? When everyone's talking about it, valuations are peak high. So you're essentially getting in right at the top. So most people, tend to actually not even make less money, and to lose money because they come in right at the top when everyone's talking about it, and that's when they sort of lose money. So I think sector funds are great if you want to, use it to I would say remove some of the stock specific risks, but really not really think. I think it's a great long-term investment. Like for example, in 2017, no one really cared about pharma. Pharma was a dead industry, and suddenly during COVID, everybody starts putting in money in pharma funds, and so people basically come at the top, which is not a very good strategy.
Yeah. Now, thanks for that, Prateek. Now, one of the points that you mentioned is more about rebalancing, which is quarterly. So my question here is really that this was a question by one of the participants, but you already addressed that in the presentation. But just to follow on to that, how will the results differ if you were to do monthly rebalancing or maybe weekly rebalancing as well? Because there are obviously high frequency traders out there who would think that probably quarter is quite a long period in their investing horizons. So how would the results vary really? If you have
Yeah.
more frequency, increased frequency of rebalancing.
Yeah. So I think rebalancing as a concept is extremely important. I think every investor should rebalance their portfolio at least once a year. But we've done a lot of studies. We've done monthly, we've done weekly, we've done yearly, and even our rebalancing, we don't really rebalance it every quarter. Only if the five, say equity goes from 60 to 65, then we sort of, only if it crosses that 5% threshold, we rebalance it back. So essentially what we've seen is that excessive rebalancing ends up in excessive transaction costs. And we've done the work, we've done the studies, we rebalance it monthly, weekly, yearly, and honestly there's not really a lot of difference in returns. There might be cases when a monthly might be better than a weekly, but it's very marginal. So what we've seen is that if there is a change in 5%, then we would do rebalance every quarter. Otherwise, we just keep the portfolio as it is. And in fact, in our funds, we've done in the last 19 years, if we look back, then we've only rebalanced both these portfolios about, I think, 17 or 18 times. So about once a year is what we're looking at. And we've done the studies and the returns are pretty much the same.
That's very interesting, Pradeep. Thanks for that. Now, one question that we have is, will 100% allocation go into passive funds?
Yes, 100%.
Okay, great. And why did you choose a broader Nifty 500 index fund, and why not a concentrated Nifty 50 index?
Yeah, so Nifty 50 is not really a good indicator of buying equities. Essentially, you're just buying the large cap, and even in the large cap, you're only buying the top 50 stocks. So I think it's not a very, I would say, efficient way of buying equity. And even within the Nifty 50 stocks, if you look at the situation today, the top 10 stocks are like 60, 70% of the index. So essentially only buying the top 15, 20 stocks, which may not be an indicator about how the economy is doing. So, and essentially, which is why we don't want to have a concentrated exposure. If you look at Nifty 500, you're essentially taking out size risk, you're taking out sector risk, and you're taking out concentration risk all in one. You're getting access to large cap, mid cap, small cap, and you're essentially getting access to 95% of India's market cap in one fund. So I think when in fact the world's biggest fund, mutual fund, is actually not the S&P 500. It's the Vanguard Total Market Index, and the Nifty 500 is actually very close to the total market index in India. That's how we chose it.
I mean, I was just thinking that maybe, not having exposure to small mid cap, might have reduced your impact cost further or the expense ratio further, because of transacting under the underlyings. But maybe, I mean, that's not the case. Can you just sort of throw some light
No,
on?
not really, because if you look at Nifty 500, 80% is large cap, 15% is mid cap, and like maybe 3 or 4% is small cap.
Right.
So you're essentially buying like almost no stocks in the small cap space. So I think literally, I think 96% of money is in the large and mid cap. So we've been running this fund for a year and a half now, and we haven't really seen any problems with tracking error or liquidity or anything like that.
Great. Now that while we are at this topic of tracking error, one specific question is that while transacting in a gold ETF and government bond ETFs, who will bear the transaction cost? What will it be included in the expense ratio charged and something? So that's more like a broader question as well. If you can cover that, will be great. Because
Sure,
there are
sure.
all sort of misconceptions around ETFs, and one of my favorite is कि यार ETFs में dividend नहीं आता, right? So these things, have to be
Yeah,
addressed like every now and then. We have to go back to basics and probably address all these things, very very frequently as well. So while
right,
we're
right.
discussing on tracking error, that's a very sort of sensitive topic for ETF investors, especially in last 1 year. Given the turmoil that we saw in exactly like around 12 months back. So that can you just throw some light on that as well?
Yeah. So first I'll talk about what tracking error is. A lot of people mistake tracking error to tracking difference, which is the difference of returns between the benchmark versus the actual fund. The actual definition of tracking error is a standard deviation. The difference in is this difference in the standard deviation of the returns. So the lower tracking error means the deviation, the standard deviations are much closer to the underlying index. So that is the technical definition of tracking error. But essentially, in this case, ETFs do not. A lot of the transaction cost, a lot of the brokerage cost, is actually borne by the investor when they're buying the ETFs, so directly. Whereas in a fund of fund structure, in case are the funds that we've launched today, the costs are shared across all investors. So if you're essentially buying an ETF of the exchange on behalf of this fund, the cost will be shared. So that's the big difference between index funds and ETFs, where index funds, I think, share the cost, transaction cost, which is also why, we don't answer very frequently, because you don't want to have high transaction costs, because that would obviously lead to a slightly larger tracking error over time. So I think that's the main difference. In the ETF, obviously, there are liquidity issues because of which you will on the exchange. So you have to really track the underlying NAV of the fund before buying. But in an index fund, you don't have to worry about that. Yes, there are costs that are shared, but because it's a passive fund, the costs are pretty minimal, to be honest.
Got it.
So the churn of a passive fund is a lot lower than an active fund.
Got it. Thanks, Pratik, for that. Now, I mean, you did address this point, but we have another question on this, and this was more about tax implications, while investing in this fund.
Yeah.
So, can you please elaborate that again? Just
Yeah.
that how.
Yeah. Sorry. Yeah, I actually missed this. Yeah, I missed this completely. So essentially, this is an extremely important point. But both these funds will be taxed as debt, so not equity. Even though you're buying an aggressive fund with close to 70% in equity, as per regulations, these will be taxed as debt. So investors should keep that in mind and invest for a minimum of 3 years. If you wait for 3 years, you can get indexation benefits, where your tax will come down dramatically because you can essentially adjust your purchase price, by inflation. So, your equity versus debt tax becomes a lot smaller. But for the first 3 years, I think it's investors need to look at this from a long-term perspective, because of the tax implications.
Great, Pratik. Thanks. And maybe one last question that we can take is, what other factors should an investor consider while investing in an FOF? So what are people missing, from normal scope of things, and what is that one needs to like keep an eye on? You very brilliantly explained the 3-year rolling returns, and I just love that point. Around that any point of investment, lump sum versus SIP, some of those differences you did cover that. But is there anything else that one should like look out for this fund, while investing?
Yeah, I think you should very important to invest as per your risk profile. And the problem is that a lot of the audience today have not really seen a negative cycle in the last 10 years. So even though people have lost money in say March or April, a lot of them have recovered very quickly. So they haven't really seen the pain of losing money, losing 60-70% of your wealth over I would say 6 months to 1 year. So I do think that a lot of investors come to me and ask me that why can't I be 100% equity? I think I want to maximize my return, but what I've seen is that most people are not able to handle so much risk. Imagine losing 60% of your portfolio, and it's right there for 6, 7, 8 months, and and everyone is talking about doom and gloom, and that 60% can easily increase to 80%. And everybody's talking about the end of the world, which has happened multiple times in the past. So in that sort of scenario, there are a lot of behavioral challenges, which is why I do really want to push the fact that investors should invest as per their risk profile. So if you use any robo advisor like Tavaga or something, it's very important for you to go out there and figure out what your risk profile is, and based on the questions they ask, and then invest accordingly. That I think is the best and prudent. And most importantly, you have to look at this from not a 2-year or 3-year, but from your 20, 25, 30-year angle. You have to be able to hold these instruments for a very, very long time. And the only way you can hold it for a very long time is to invest as per your risk profile. So it's extremely important. The secret thing about investing is not about what to invest or what is your asset allocation. Obviously, that's an important decision. But the secret is time. You really have to be in the markets for 10, 15, 20, 30 years, and for compounding to happen in a very seamless where you can get sleep all the time. You really need to make sure that you invest as per your risk profile. So I think that is very important, which is why we have 3 options. And investors can really think deep and hard about what they're looking for and invest accordingly. So that's very important.
No, great, Pratik. Thanks. I mean, I'll just add to this point because you did mention about risk profiling. So the number one request that we receive at Tavaga is to upgrade the risk profile. That is, while doing the risk profiling, we work out people who are like slightly conservative or slightly growth oriented or something, and then they suddenly realize, oh no, they want to invest like really aggressively into equity. So really pushing the basic concept like asset allocation or risk diversification like becomes like a task in itself to explain to them that, listen, yes, that's great, but it's not probably for you at some point of time. But yeah, that's a pushback that we also get all the time.
Yeah. So behaviorally, what people do is they tend to be aggressive in bull markets and conservative in bear markets, which is a horrible strategy. That's a short way of losing money. The best strategy is in fact the opposite. When and it's a much harder strategy because you're conservative when everyone's making a lot of money, and you're aggressive when no one is making money. But that is actually the best strategy for you. So imagine if you went April, May, you would have made a killing right now. And imagine going conservative, right now. It's a very poor strategy you have right now because you want to make those gains ahead. So I think it's very important, which is why the best strategy is to stick to where you are. If you have a allocation, make sure you stick there. Or if you want to change your allocation, make sure you stick to your new allocation for the rest of your life. But never change allocations. That's a recipe for disaster.
Great, Pratik. On that note, we'll end this session. But thanks again for joining us. Really appreciate your time on this and educating us on the new fund offering. Wish you all the very best for marketing, and we'll speak again in future.
Sure. Thanks, Nitin. Thank you for having me out here. Thank you, Tavaga. And if anyone has any questions, please feel free to use contact me on social. I'm always very active, and I'll be more than happy to take your calls and messages. Thank you so much. Thank you so much, everyone.
Thanks, Pratik. Bye bye.
Thanks.